Every bond has special terms and conditions stipulated in the bond prospectus, this document. Kenyan bond investors are used to long-term bonds with only one redemption date, and the redemption date is when your principal amount is paid back in full. For example, an 18-year bond issued in 2023 where your full principal amount will be paid back in 2041. The March 2023 infrastructure bond, the first infrastructure bond of 2023, has two conditions that people seem not to understand, and as always, I've been receiving numerous questions from the Wealth Tribe. Now, you need to understand these two terms and conditions before you invest in this bond. These two conditions are the redemption structure and the amortization. The redemption structure simply answers the question, when will your principal amount be repaid? And the amortization is simply the gradual or the regular repayment of the principal of the bond and the interest in the course of the life of the bond. It's simply the process of repaying off a debt with regular repayments. You know that a bond is a debt instrument, right? A bond is simply the government of Kenya borrowing money from us, its citizens, in order to finance its various projects. Now that you understand the meaning of the two conditions, let's look at the specifics of this March 2023 infrastructure bond. The tenor, or the time period rather, is 17 years. The redemption date is 20th of February 2040. The coupon rate, it says that it's market determined, and I will explain what this means at the end of this video. The period of sale started on the 15th of February 2023 and it will end on 7th March 2023. The value date, and this is when your amount has to be received by CBK for crediting, is the 13th of March 2023. The amount on offer, or the amount that the government of Kenya is looking for, is 50 billion. And what is the purpose of this infrastructure bond? Is for funding of infrastructure projects in the financial year 2022-2023 budget estimates. And what is the minimum amount that you can invest? It's 100,000. Now let's look at what the redemption structure states. It states 28th February 2033, 50% of unencumbered outstanding principal amount, and then on 20th February 2040, 100% final redemption of all outstanding amounts. Then the amortization, it reads, no partial redemption will be paid on unencumbered securities on amortization dates. Any amounts up to 1 million per CDS account at amortization will be redeemed in full except for encumbered securities. Let's first understand the meaning of this word, encumbered securities. Encumbered securities is simply bonds that have been used as collateral for a loan. Yes, you can use either a part of or 100% of your bond to get a loan facility from a financial institution. For example, when real estate investors often use the word, the land has encumbrances after a land search. This is usually to mean that this land cannot be transferred to another person because that land has been used to acquire a loan. So it's the same concept. So if you use your bond, to acquire a loan, then this bond amortization and the redemption structure will mean different things, and I'm about to explain that. So what do these terms and conditions mean? These are redemption structure and amortization. What exactly do these things mean to you as an investor, or what do these terms and conditions mean in layman's language? It simply means that if you invest 1 million shillings or less, you will get your full principal amount in 10 years. Yes, if you invest 1 million shillings or less, you will get your full principal amount on 20th February 2033. In a nutshell, this is a 10-year infrastructure bond for anyone who invests 1 million shillings or less. And it also means that if you invest 10 million shillings or less, you will get your full principal amount on 28th February 2033, and this also means that this will be the end of you receiving any interest payments from Central Bank of Kenya. Now let us look at practical examples of what this redemption structure and amortization mean. If if you invest 100,000 shillings, if you invest the minimum 100,000 shillings, then use 20,000 shillings of your bond as collateral for a loan, the 20,000 shillings will be encumbered. If you won't have paid back your loan by 28 February 2033, only the 80,000 shillings will be paid back. The 20,000 shillings will be paid during the final redemption date. If you invest 1,000,000 shillings, then use 20% of your bond as collateral. The 200,000 will be encumbered. If you won't have paid back your loan by 28 February 2033, only 800,000 will be paid back. The 200,000 will be paid back during the final redemption date. Is receiving your principal amount earlier a good thing or a bad thing? It's a great thing for us retail investors who invest less than 1 million. So instead of having to wait for a whole 17 years, we are going to get back our principal amount in 10 years instead. And this is a good thing because when we get back our principal amount, we can either spend the money or ideally we can invest this money in other higher yielding investments such as the stock market. Reason number 2 why it's a great thing to get your money faster or to get your money in 10 years as opposed to waiting for 17 years is because it lowers your inflation risk. Remember that investing in bonds is not inflation adjusted. This means that, for example, if we get a 14% coupon rate for this infrastructure bond, we are going to be receiving 14% for either the next 10 years or 17 years. It's fixed. That's why treasury bills and treasury bonds are called fixed income securities. That is the interest rate you're going to be receiving, whether inflation rates shoot to 14%, 12%, it doesn't matter. It's fixed. That's the interest rate you're going to be receiving. And so you know that the rising interest rates are a risk to long-term investments. We usually say that higher interest rates is equals to lower bond prices. In other words, interest rates are expected to rise in line with rising inflation. So investors are wary of the risk rising interest rates pose to the market value of bonds. Rising interest rates affect the market value of bonds, especially bonds with longer maturities. Being able to cash in part of your principal sooner gives you the ability to invest in other high yielding instruments. What of those who invest more than 1 million? Those who invest more than 1 million will get half of their principal amount in 10 years. That is, on 28 February 2033, you'll get back 50% of your principal amount, and the other half will be paid after the 17 years. That is, on 20th February 2040. If you use 100% of your bond as collateral for a loan, this partial redemption will not apply to you. That means that on the 28th of February 2033, half of your principal will not be paid back to you. Okay, so now let's look at practical examples for those people who invest more than 1 million. If you invest 1,050,000, then use 150,000 of your bond as collateral for a loan, then the 150,000 will be unencumbered. On 28th February 2033, you'll receive 50% of your unencumbered amount, that is 450,000. You'll receive the rest of your principal amount on 28th February 2040. If you invest 5 million shillings, then use 1 million of your bond as collateral for a loan, the 1 million will be encumbered. On 20th February 2033, you'll receive 50% of your unencumbered amount. You'll receive the rest of your principal amount on 28th February 2040. Other frequently asked questions about the March infrastructure bond. Question number 1, what does the market determined coupon rate mean? I like to use a practical example in order to help you understand this concept. Imagine a situation where you wake up one morning and go to the shop next to where you live and ask the shopkeeper, how much are you going to sell me this loaf of bread? And the shopkeeper asks you, how much do you want to buy this loaf of bread? And then your next door neighbor goes to the same shop and asks the shopkeeper the same question, how much is this loaf of bread? And the shopkeeper asks the same question, how much do you want to buy? And then your third neighbor goes to the same shop and the same thing happens. Then at the end of the day, if, for example, you said that you want to buy this piece of bread for 50 bob, and then your neighbor says that they want to buy the loaf of bread at 60 shillings, and then your third neighbor says they want to buy this loaf of bread at 70 shillings. At the end of the day, what this shopkeeper is going to do is going to take those three figures add them together and do an average. Then that is going to be the cost of that loaf of bread. This is the same concept. This is the same thing when it comes to bonds, when we are told that bonds are market determined. So what will happen is that the coupon rate for this bond will be determined through the auction process when investors submit their bid, right? So each one of us who wants to invest in this bond is going to submit a bid, because bonds are usually auctioned. And then when the auction process is done, or when the bidding time period is done, we will know the average when the period of sale ends. Yeah, so at the end of when the period of sale for this bond ends, that's when we will know what is the coupon rate. So that's what it means when they say that the coupon rate is market determined. So even I don't know what is the coupon rate for this bond. Question number 2. If you can't invest in the bond, will the bond be reopened in the future? The bond prospectus that we saw says that the bond may be reopened at a future date, and the reopening of a bond is usually at the sole discretion of the Central Bank of Kenya. So we don't know when or if this bond is going to be reopened. But don't worry, even if you don't have the money now, you don't have the 100,000 now, and which means you're going to miss out on the primary sale of the bond, you can also buy this bond. You can always trade this bond or buy this bond on the Nairobi Securities Exchange in multiples of 50,000. So in fact, when you invest in this bond, you can invest with as little as 50,000 as opposed to with 100,000. And of course, the price of this bond when it's traded at the Nairobi Securities Exchange is going to be much more expensive than how much you would have bought it at the primary market, that is the Central Bank of Kenya. So it's always advisable to invest in a bond. I always advise people, ideally it's better to invest in a bond on the primary market through the Central Bank of Kenya as opposed to trading it on the Nairobi Securities Exchange. And for you to trade the bond on the Nairobi Securities Exchange, you're going to use the CDS account that you use when you're buying stocks, that is stocks of Equity, KCB, Safaricom, all those. That is the CDS account you're going to use. So you're going to use your stockbroker in order to trade the bond on the Nairobi Securities Exchange. But on the primary market, that is when you're buying it on the primary market, means buying it at the Central Bank of Kenya. For you to buy it at the primary market, you will use the CDS account maintained at the Central Bank of Kenya. So I hope you get the difference. And then somebody else also asked me, how do you bid for this bond? You bid for the, okay, so you to bid or for you to invest in this bond, you need a CDS account maintained at the Central Bank of Kenya. Listen, this is a different CDS account. These are different CDS account from the CDS account that you use to buy or to trade securities or shares. This is a different CDS account from the CDS account that you have with your stockbroker that you use to buy shares. So you basically, as an investor in Kenya, you need two types of CDS account. One with your stockbroker to buy stocks or shares, and one maintained at the Central Bank of Kenya to invest in treasury bills and treasury bonds. Two of them, because I'm insisting, because I've received this question on my Instagram multiple times. So I hope this settles it. Now, then let's go back to how do you bid for this bond. You bid for this bond when you have a CDS account maintained at the Central Bank of Kenya. You simply use the CBK TMD or Treasury Mobile Direct USSD code. You press star 866 hash. You follow the prompts, and you follow the prompts, submit your bid, and wait you'll receive a message from the Central Bank of Kenya telling you whether your bid is successful or whether your bid is unsuccessful. If this is new information to you, if investing in a bond is new information to you, I will leave the ultimate beginner's guide on investing in treasury bonds in the description box. Please click that link and learn how to invest in bonds. This video was specifically about the March 2023 infrastructure bond. If you currently don't have a CDS account with the Central Bank of Kenya, you can also invest in this bond through other financial institutions such as commercial banks, investment banks, licensed financial institutions, or licensed investment advisors. But of course, these financial institutions are going to charge you a management fee to invest in this bond. And that's why I always advise people, it's best to just go to the Central Bank of Kenya, collect your application form, and create a CDS account at the Central Bank of Kenya, as opposed to having to incur those management fees that you're going to be charged. Question number 4, why should you invest in this infrastructure bond? 1, passive income. Every 6 months you're going to be paid interest if you invest in this bond, and this interest is going to be credited to your bank account. Reason number 2, infrastructure bonds or bonds in general in Kenya have relatively high returns. I've been checking online, and financial analysts that predict that we are going to get either between 14.2 and 14.9% from this infrastructure bond. Though from this specific infrastructure bond, that's a relatively high return. So why should you miss out on getting a whooping between 14.2 and 14.9 interest rate? Please submit your bid if you have a CDS account. Reason number 3 why you should invest in this bond. Infrastructure bonds are usually tax exempt, so they're exempted from withholding tax. So take advantage of an investment that is not going to be taxed. Number 4, it's a risk-free investment. So yeah, the government of Kenya has never failed or has never defaulted to pay either the principal or the interest payments for infrastructure bonds or bonds in general. So yeah, take advantage of a risk-free investment and put your money in there. And then advantage number 5 is that when you invest in infrastructure bonds, as I said earlier, you can use your infrastructure bond or any bond in general to get a loan from a financial institution. So if you're a bond investor, just walk into your bank and tell them that you've invested in a bond, and ask them if you want a loan, that is, and ask them to give you a loan facility, and I'm sure you can negotiate the terms and you can have access to a loan. So having a plot of land or a rental house is not the only way for you to get loan access, or it's not the only collateral you can use to access a loan facility from a financial institution. Even investing a bond is a way to have access to loans from commercial institutions. And then finally, if you invest in this bond and 5 years later you feel that, oh no, I can't continue holding on to this bond for the rest of the 10 years or for the rest of the 17 years because I need the money, you can always sell this bond on the Nairobi Securities Exchange platform through your stockbroker. My name is Agatha from the Wealth Tribe, and this is where we learn how to build wealth together. As always, click the like button, share this video, subscribe to this channel, and as always, I will always inform you when there is a new infrastructure bond. So I'm sure that's good enough reason for you to subscribe to this channel.